All right, so here we have some data. Barton Robotics manufacturing overhead budget. This is the static, original, master part of the budget. All right, so this is what management had planned for 2014 to be like. So they had budgeted for X number of units to be sold, and then this is for the actual units to be produced per the production budget. How much is it going to cost? Here you can see that they have planned for the budgeted production in units, uh, specifically a part called the robotic controls, to be 10,000 units. And then they have all of the different line items of cost necessary in order to produce them. Indirect materials, 250,000. Indirect labor, 260,000. Utilities, 190,000. Depreciation, 280,000. Property taxes, 70,000. And supervision, 50,000, for a total estimated to be spent $1,100,000. But did they produce 10,000 units in 2014? That would be a question to answer with our actual information gathered. And then how much did the cost total for 2014? Because it's likely to be different than the totals here. And we need that information in order to perform an analysis. Well, we can see that right here is our column that has actual results in it. Instead of 10,000 units produced, the company actually produced 12,000 units. And their cost for those 12,000 units, indirect materials, total actually spent $295,000. Indirect labor, total actually spent $312,000. Utilities, total spent $225,000. Depreciation, total spent $280,000. Property taxes, $70,000. Supervision, $50,000, for a total actually spent of $1,232,000. Now, on its face, we could take the actual costs and expenses here and compare them to the budgeted numbers from the master static budget. And we could just go down through here and see that this one is $45,000 more expensive than this one, and this one is $52,000 more expensive than this one, $35,000 more expensive than this one. No difference, no difference, no difference. Okay, so here are those amounts. U is for unfavorable. Again, the actual is more expensive than what was originally budgeted. And this shows us that it's 132,000 unfavorable actual versus the original master budget number. But however, I want you guys to notice, are we really talking apples to apples here? No, we are not. Notice that there is a $2,000 unit difference. 2,000 more units were actually produced than what was originally budgeted in the production budget of the master budget. So wouldn't we expect these numbers for the items that are variable cost in nature to be more than 10,000 units worth? And that, in essence, is what we're going to be doing when we flex the budget. This is not giving us useful information here for comparison purposes. we need to flex our information from the master static budget. We need to change this number to 12,000 and change the total amount of cost that we would then expect for 12,000 and then compare that to the actual results. All right, so initially, just looking at the 12,000 versus 10,000, we can see that we've overspent, we're over budget in 3 of the 6 overhead cost categories. If you were to do that as a percentage, it would be 12% over budget. But again, this comparison is based on the budget data for 10,000 units, not 12,000 like the actual results are. The original activity level is therefore not relevant. We cannot compare apples to apples here. So it's meaningless. Therefore, we need to flex our budget in order to be able to do an actual analysis of our information. Because we know that those 12,000 units would cost us more in total variable cost than the 10,000 units would. So our budgeted variable amounts should increase proportionately with production. So here, if we were to go back, we could literally calculate a per unit amount for each one of our types of items that's in a way variable or mixed in nature. All right, so if you were to take the original 10,000 units and divide it into the total cost that we saw on the budgeted numbers, the original budgeted numbers from the production budget, you would get $25 per unit for indirect materials. You would get $26 per unit for indirect labor. And then for our utilities, $19 per unit. And then we could take those numbers and multiply them times the new 12,000 actual quantity in units and get better numbers to compare to our actual results. Now, again, the actual results are the total amount spent, literally spent. And this right here that we're calculating is a flexed budget for these numbers for 12,000 units. All right, so 25 times 12,000 equals 300 grand expected in indirect materials cost. 26 times 12,000 equals 312,000 expected in indirect labor cost, and 19 times 12,000 for a total of 228,000 expected in utilities cost. So again, these dollar amounts per unit are based on our planning that we did back in chapter 21, where we got information from all levels within the company. Remember that participatory budgeting. And these are the numbers that we're going to expect to have to pay. And we're just going to take that and multiply it out now times our 12,000 units. And this is what we need to compare to our actual costs and expenses for the period. So, in developing the flexible budget, first thing we have to do is identify the activity index and the relevant range of activity. Recall that the relevant range is that range of number of units or the activity that drives cost, and we expect those costs to remain the same per unit within that relevant range. We talked about that multiple chapters ago. We would identify the variable cost components and determine the budgeted variable cost per unit of activity for each cost. Again, this is just a repeat of what we've seen in 21. What do we believe our variable cost per unit will be for each unit that we're producing or possibly buying if it's direct materials? And we're going to use that per unit against our actual quantity. We also need to take a look at our fixed cost. And again, they're within that relevant range. We do not expect the fixed cost in total to change at all. And then we will use the fixed cost per relevant range. We don't expect anything to change. But if our actual results differ from what we expected for a specific range, then management is going to be looking into that deeper during this analysis phase. And then lastly, we're going to prepare the budget for the selected increments of activity within that relevant range. So let's take a look here for preparing the budget report based on flexing the number to equal the actual quantity or units of production so that we can now talk apples to apples. All right, so recall that we calculated a variable cost per unit of indirect materials at 25, a variable cost per unit for indirect labor at 26, and utilities at 19 per unit. We now want to take that number and multiply it times 12,000 in order to get what we would have expected our actual results to be. So this is our expectation. This is our flexed budget. So if you take 12,000 times 25, you get 300,000. This is what we would have expected to spend in indirect materials while producing 12,000 units. What we actually spent, though, was a total of 295,000. 295,000 actually spent versus 300,000 estimated or expected per our initial master budget preparation means that we have spent 5,000 less than what we had planned on. So it's 5,000 favorable. Indirect labor, $26 per unit times 12,000 gives us a total of 312,000 expected in indirect labor, and we actually spent 312,000. So there's no difference whatsoever, zero. 19 per unit in utilities times 12,000 units equals 228,000. 228,000 is more expensive or costly than 225,000. So we actually have saved some money. We have spent less on utilities by $3,000. Therefore, it is favorable. So our total variable cost flexed for the actual quantity of units of 12,000. We would have expected to spend $840, but we actually spent $832,000 instead. So therefore we are $8,000 favorable. Again, I want to highlight that if you have $5,000 favorable here, and let's say this said $3,000 unfavorable here, again favorable, and let's imagine this says unfavorable, we would net those two together and have a $2,000 favorable at the bottom. So if you have favorable and unfavorable, you will have to use the favorable as a positive number and the unfavorable as a negative number to get your total difference at the bottom. All right, let's look at our fixed cost. For depreciation, We expected $280,000. We spent $280,000. Therefore, we have no difference whatsoever. Property taxes, again, the fixed costs, we expect them to stay the same within that relevant range. We're not having to add additional plant capacity in some way, shape, or form. Property taxes, we don't expect them to change if we don't plan on having to gather more property, plant, and equipment in order to have capacity. So no change. Supervision, the supervisor salaries, we expected to spend $50,000. We spent $50,000. We have no difference there. Total fixed cost, we expected $400,000. We spent $400,000. We have no difference. We can then plot out and look at our total variable cost, $8,000 favorable, and look at our total fixed cost, no difference, and find our total cost, which is the two together, variable plus fixed equals total cost. We have $8,000 favorable result here. So let's take a look at another one here. We've got Fox Companies Management. They've got their variable cost totaled out and their fixed cost totaled out for a particular time frame for a year from their master budget. And this is for one particular department within the company. They are expecting their annual operating activity to be 120,000 direct labor hours, and these are their overhead costs. Just like we performed in multiple chapters ago, we can use the expected overhead for a year, and we can divide that by the expected activity for the year and use that number to allocate the overhead in to our budgeted numbers. So we've got $480,000 in variable cost and we have $360,000 in fixed cost. So let's identify the fact that we have an activity index, and that activity index is direct labor hours for Fox, and that we expect our information to be usable within a relevant range of 8,000 to 12,000 direct labor hours per month. Now again, what did we have for the year? If you were to go back, 120,000 for the year, so 120,000 divided by 12 months would be 10,000 per month on average. If we take the variable cost and divide it by the expected activity for the year, we can get our variable cost per the activity for each unit. All right, so in regards to our indirect materials, we have $180,000 total. We're going to divide that by the 120,000 in direct labor hours and get $1.50 per direct labor hour for our indirect materials. For our indirect labor, a total of $240,000 is expected for the year. Divide it by the 120,000 hours, we get $2 per direct labor hour for our indirect labor. And for our utilities, we have $60,000 estimated for the year. Divide it by 120,000 estimated direct labor hours, and we get 50 cents per direct labor hour. We can then total these up and estimate that for each direct labor hour worked, we will have $4 even in these manufacturing overhead type of costs. The fixed cost, again, we do not expect them to change in total within the relevant range. We just need to identify what those fixed costs are and determine how much should be budgeted for those specific amounts. So we have depreciation. We're not adding any additional plant capacity within that relevant range. We can determine in advance what our depreciation costs will be. If we're not having to hire any additional supervisors within that relevant range, we are going to know exactly what our supervisor salaries are going to be. So determine that amount. Property taxes, calculate what those need to be. And notice, folks, that this is telling us per month. Could we have taken the total amount for the year and divided it by 12 months in order to get the monthly amount that needs to be calculated? So when Wiley gives you this information for your problems, you need to calculate monthly amounts. So if they give you an annual rate and you're doing a monthly budget of some sort, you may need to divide by 12 in order to put the correct number in the box. We can then prepare the budget for the selected increments within that relevant range for our activity level. So at Fox, they're going to prepare theirs in increments of 1,000 direct labor hours. So this is what it would look like if we had prepared our monthly manufacturing overhead flexible budget based on our ranges of 8,000, 9,000, 10,000, 11,000, and 12,000 direct labor hours. These are the amounts that we would expect. So for 8,000 direct labor hours, our total variable cost would be 32,000. Notice our total fixed cost is 30 all across the board. And here's our total cost line. The only thing that's different between 8, 9, 10, 11, and 12,000 indirect labor hours worked is the fact that these variable costs in total vary proportionately with the quantity of the activity. And this one is direct labor hours. So for each additional direct labor hour, you're going to have an extra $1.50, an extra $2, and an extra 50 cents in total variable cost. Fox can use the same formula that we learned in a prior chapter in determining what our total budgeted cost will be at any level of activity. Recall that the formula was X, as in quantity, times variable cost per unit plus fixed cost. So the fixed cost is a set amount we expect. It's not going to change in total. It's going to be the same every time. And then our variable cost, the total variable cost, changes in total proportionately with whatever the activity is, whatever the driver is of those costs. So again, it's the quantity of units times dollars per unit to give us a total variable cost. So if we were to go back and plug in our formula, here they're wanting us to determine what is the total budgeted cost for Fox if their fixed costs are 30,000 and their variable cost per unit is $4. Well, if it's 9,000 direct labor hours is expected, we're going to take 9,000 times 4, add that number to 30,000. For the next one, they want us to do it for 8,622. Take your calculator out. 8,622 times 4 equals a number. Add that number to 30,000. So calculating those two, The 9,000 direct labor hours would cost us a total of 66,000. And for the 8,622, it would be an estimated 64,488. Here is a example of how we could literally graph our flexible budget information. Again, using the formula like we saw on the slide before, we've got a fixed cost portion. Notice here that our fixed cost line, no matter the quantity difference in the activity, it's going to remain the same. So here's our baseline, if you will. $30,000 in fixed cost. Okay? Doesn't matter the quantity, it's going to be $30,000. And then our variable cost is going to be $4 per unit times X number of units. And that's in this budgeted variable cost area right here. Plugging those numbers into the formula, we would see a line that would develop because that formula can be used in order to put this graph together. I'm going to pick back up here and discuss the flexible budget reports and how to use them in analysis.